Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Hello, listeners. Welcome to Business Line's monthly personal finance podcast. Today, everybody is talking about the stock markets, but there is an exciting investment opportunity to invest in bonds as well, because with the steady rise in interest rates, today even government bonds in India for 10 years or so are available at 7.4%. And this means that many AAA-rated bonds are at 8% or more. So we have with us today Mr. Vishal Goenka, who's the co-founder of Indiabonds, an online bond platform that enables investors to actually access various types of bonds and invest in them pretty seamlessly through a digital interface. So Mr. Vishal Goenka is a veteran of the bond markets. He has over 2 decades of experience in debt, distressed debt, loans, derivative products, structured products, and so on. And we've seen that platforms like Indiabonds have actually provided great access to retail investors to corporate bonds, which are not available before. Over to the interview now. Mr. Goenka, a retail investor looking to buy bonds today, if he wants to buy public issues of NCDs, he can go to stockbrokers. If he wants to buy government bonds, the person can go to the RBI Retail Direct platform. So what are the new categories of bonds that platforms like Indiabonds open up to the investor?
Aarti, firstly, thank you for having me over on your podcast. I think the bond universe in India is a very exciting investment class. It's a $2.5 trillion market, which people do not realize. Thanks to the online bond platforms, the access and the awareness of this is building, and podcasts like this will help to build further investor awareness. On to your question, access to bond markets have been there historically, but it's all about convenience and information. For example, you could access bonds through stockbrokers, but there's no information available with that historically. The pricing or the quoting mechanism is also very different. Bonds have a component of principal and then the interest. So the way they are quoted on the exchanges is not really the conventional way they're quoted on institutions. Hence, online bond platforms now, which are regulated by SEBI, provide a detailed information on each and every bond that you were to purchase. It has information memorandums, it has rating rationales, it has the entire coupon schedule until maturity. And platforms like us also provide you the entire cash flow for the tenor of the bonds. Now, this kind of information was lacking. Hence, we see investors coming to platforms, learning about their investment themselves and choosing this over the traditional stock brokering route. In the RBI retail has had a lot of success, and the government has actually put the spotlight and focus and shows the forward-looking thought. The only difference between buying a government bond from RBI retail and online is RBI retail, when you open an account, automatically opens a so-called SGL ledger account with them in which you hold the government securities. Platforms like us actually provide the facility of providing government bonds in the demat account, because most investors have all the financial securities in their demat accounts, whether it's equities, bonds, mutual fund units. So investors still choose online bound platforms because they can see all their holdings in one place.
Absolutely. I get that point, because when you try to buy a particular stock on a stockbroking platform, you immediately know the ticker and you can use the name of the company to search. Whereas in the case of bonds, there could be multiple issues with the same kind of bond, and it's very hard to locate what you want. So I think definitely by simplifying that process, the online bond platforms are actually delivering a big service to the retail investor. So I want to know that platforms like yours mainly offer NCDs or non-convertible debentures, both from companies and banks and other financial institutions.
That's right.
We also have other kinds of online bond platforms which are offering, I wouldn't call them online bond platforms, online platforms offering P2P lending or participation in invoice discounting, which also seem to offer very high yields. So how would you compare and contrast investing in NCDs versus those options?
Yes, so I think the awareness in investing in fixed income or returns for individuals is growing. There is absolutely bonds and P2P and invoice are not comparable at all
Yeah.
to start with. Uh, we are putting them together in one bucket. For example, the bond market, I said, is a $2.5 trillion market. The entire P2P market is not even 750 million, right? So there are significant differences. The one big difference that you spoke about, that buying a bond on an OBP platform is a regulated platform by SEBI. Bonds
Right.
itself are oversight and regulated by SEBI. Some of the P2P is also kind of coming under regulation. Invoice discounting has no oversight of regulation. So obviously
Okay.
the risks are aligned accordingly. I'll take them one by one. Invoice discounting is really unsecured short-term lending. It is almost like, a friend asking you for money for 3 to 6 months. Obviously, in this case, the discount is over receivables to some other companies. These things
Right.
actually have a very high risk and hence a high return, right? So they offer anything between 12 to 18%.
Yeah.
They're usually on very weak documentation. There's a tripartite agreement, and it's really, there could be many things that can go wrong. Even as per IBC, the bankruptcy code, invoice discounting is part of operational debt. So it comes below unsecured creditors as well in case of
Oh,
bankruptcy. So,
okay.
so people, again, I think podcasts like this will help to build that awareness that
Right.
yes, you are getting a higher return, but you're taking significantly higher risk. You can
Right.
buy secured bonds at 11.5%. To look for that 13-14%, your risk is much, much higher. So they're really,
Yeah.
really very different. And platforms that show invoice discounted are not regulated. So they're not online bond platforms. There are more
Yep.
e-commerce websites,
Right.
which I would like to think. The
Right.
P2P is a different ballgame. It is a pool of borrowers and it promises returns 12 to 15%.
Yeah.
Now, this pool of borrowers, by default selection, are probably not getting loans from traditional banking sectors, NBFCs, or even sophisticated large lending platforms. Hence, they seek such kind of P2P platforms. The
Yeah.
good thing is that optically it looks diversified, that I'm lending to about 10, 15, 20, or even 100 borrowers, but completely unsecured. There is no recovery, no regulation. There is no recourse in these cases, and hence maybe you get a slightly higher return. And
Right.
importantly, I sometimes think these are bull market products because of the economic cycle the country is in, or the
Yeah.
credit cleansing that is happening. But if we were to get a little economic shock, then the default rate on these pools of assets, because they are mostly what in the Western world called subprime, right? So
Okay.
the default rates could be very high if there was an economic shock. So the risk is significantly higher. And again, I rather be in the security of a listed bond, which has oversight of SEBI, which is secured by some collateral of the company, and have regular disclosure from that company.
Absolutely. To clarify here, what Mr. Goenka means by risk here is that you may not get your principal back, though you may get a high yield for some time or for a very temporary period. That's what you mean, right?
I mean, default rates are higher, right? So
Yeah. Yeah.
any asset does have that principal risk, and that's why there is a risk
Mm.
return. But sometimes I feel that the pool of borrowers here are pretty weak.
Mm. So, talking of listed bonds and how they are SEBI regulated and have SEBI oversight, that's true that it is a more regulated space, and SEBI has a lot of LODR regulations also applying to listed bonds. So, companies who are listing their bonds have to make a lot of financial disclosures and so on. But what about the liquidity aspect? The fact that a bond is listed on the stock exchanges, does that mean that the investor in those bonds can exit at any time? What do the trading volumes actually look like?
So very good question. So let me compare, how do you compare listed bonds today, right? So typically listed bonds do have more liquidity as compared to, let's say, unlisted bonds, which have
Mm.
practically, a zero liquidity. As you correctly said, being listed means there is a prescribed law and format by SEBI, whereby the issuer has to disclose, financial health of the company on a, let's say, quarterly basis, disclose its financials. So a person who's invested can actually keep track. If there is any kind of deterioration, you get the signals little little up ahead. Uh,
Yeah.
Exit from bond investments, like any other asset class, is subject to market conditions. I
Mm,
always think trading volumes in bonds will continue to be improved. But if I compare high yield bonds to even
mm,
internationally, there's a bid offer of 1 or 2%. So
okay.
similarly, high yield bonds in India do have that bid offer, right? So if you were to
Mm,
exit, yes, you can get an exit, but it'll be subject to market conditions. But
right.
importantly, let me tell you that at least listed bonds have a potential of exit,
Mm,
unlike alternative investments, right? So as you
true.
mentioned,
True.
P2P, there is no exit. Invoice
Mm,
discounting, there is no exit.
mm,
Structured debt or structured credit has no exit.
right.
Even some of the government bond schemes, like National Savings Certificate
Mm,
and things like that, have lock-ins of 5 to 10 years.
true.
Okay, even if you
True.
take FDs, there's usually a penalty. So if I compare to any other so-called
Mm,
fixed income giving asset class, have practically zero exit. At least in
yeah.
listed bonds, there is a market, right? We all wish
Right.
that the markets were much more liquid, but there is an
True.
exit. I mean, just to give you an example, uh, the volatility in the US government bond market is much more than the Indian government bond market in the last 1 month, right? So,
Yeah, I've
you
been seeing it. The yields have been going up and down like
know,
crazy.
yes. So we should be comfortable that we have a much resilient economy, a resilient bond
Right.
market with a good oversight. Since the corporate bond market is growing, liquidity will be found and will keep growing. But I think the awareness, the transparency is what should make an investor comfortable, that you're not
Right.
buying an illiquid piece of paper and you have
Mm,
no idea of an exit. In bonds, at least
right.
you can see a price, you can compare, and you have a
Mm.
possibility of a good exit.
That's an excellent point. That most fixed income products in India do not have premature exit. You have to hold them till maturity. At least here, there is an option in case the trading volumes are good. Yeah. So I find online bond platforms offering both privately placed bonds and public issues. And I do know that in India, over 95% of the issuers actually take the private placement route. So this actually opens up access to the retail investor. But should the investor, given a choice between public issue and private placement, should he or she go for a public issue?
So there are benefits of a public listed issue, right? So the denomination
Mm,
can be usually as little as 10,000 rupees. They tend to have more liquidity, but they're usually, because there's a very diverse pool of investors in public issues. Public issues carve out
mm,
allocation to retail, to HNI and corporate bodies and QIBs or institutions. So, perceptibly there is more liquidity. However, private placements are two types. One is unlisted and listed. So
mm, mm.
my views on unlisted. I think
Yeah,
retail should just stay away from unlisted. So if we
absolutely.
talk about private placements which are listed, which means they
Yeah.
still have a large amount of regulatory disclosure to follow, it is all
Mm,
right to invest in them. In fact, these private listed placements are actually placed to large institutions in this country. For
yeah.
example, if an issuer had to raise a well-known name issuer, well highly rated, 1,000
Mm,
crores, they can call maybe 10 investors and raise 100 crores each. So that
mm,
is
mm.
easier on the issuer. The good thing
Correct.
is that from January 23 this year, the minimum ticket size for an investor to buy private listed went down from
Mm.
10 lakhs to 1 lakh.
Oh, okay.
Yeah. So this was to encourage people to stay away from unlisted. And even if it is private, but it is listed, it
Right.
is relatively much, much safer and almost, I would say, equal to a public listed. Though public listed
Okay.
may just have little more liquidity in the secondary market.
Right. So when online bond platform, they actually offer privately placed securities or buy up bonds from the secondary market and offer it to retail investors. When the retail investor wants premature exit, can they come back to you for an exit? I mean, would you be able to find them a counterparty?
Yeah, so typically, Indiabonds, we are a platform which matches buyers and sellers, right? So if people were, and we encourage people to even test it out, were to come and offer bonds
Mm,
to sell, we make all
mm,
efforts to find the right buyer, via SEBI prescribed RFQ process.
mm,
We are
mm,
not a
mm.
market maker or deemed exchange and provide any firm two-way prices. We are a pure platform. But yes,
Right.
customers who usually have bought from us, if they were to sell, we definitely help them to
Okay.
find buyers, and we have done a lot of transactions in the same way. Yes.
Right, right. So retail investors, when they choose bonds, they are usually tempted to go for the ones with the highest yields. So
Mhm.
today I see triple B entities, for example, on some platforms offering 12% or 13%. But what due diligence should investors do when buying high yield bonds?
Sure. So first thing is, you can buy bonds, as you said earlier in the call, from 7% to 12%
Right.
secured bonds, right? So investors should first make sure that high yield is suits their risk appetite. So usually high yield bonds are like A plus, A minus, or credit ratings.
Hmm.
Some even go to triple B, and we can talk about triple B as well. And I would like to talk to our investors on that. But when
Yeah.
you're buying a high yield, the name itself tells you that it's not a government bond, right? So it has a certain higher
True.
risk. Now, what do you do in that? In India, we've been very quick to learn about equity markets, especially since COVID, and people have made an
Absolutely.
effort because it is ultimately your money, right?
Yeah.
The buyer beware syndrome is for anything you buy in life and even in financial securities, right? So when you're buying a high yield bond today on a platform, you should read the information memorandum, which is available. You should read the rating rationale. Rating rationale is issued by credit rating agencies, which are regulated entities, which explain
Right.
to you the business of the issuer.
Right.
Investors should also familiarize themselves with the industry sector. So,
Hmm.
it could be NBFC, but is it an NBFC in SME loans? Is it NBFC
Hmm.
in retail loans, SME, wholesale credit? So people should know what they are getting into.
Hmm.
Attention should be paid to collateral or security. What kind of security you have? Is it a
Hmm.
general security over company's assets? Is it a single asset? Is it a collateral pool of loans that they have security over? Uh,
Right.
if I were to tell not to get too technical, but there are also something called financial ratios. But I will highlight
Hmm.
only four ratios for
Yeah.
credit.
Yeah.
One is leverage ratio, which is debt
Hmm.
to equity. How much debt does the company have versus the equity?
Right.
Second, and these all disclosed, in the information memorandum,
Hmm.
interest coverage ratio. How well
Hmm.
are they set to cover the interest payout in the next few years?
Right.
Liquidity ratio, which means how liquid they are versus current assets versus liabilities,
Hmm.
and profitability. Obviously, if you're investing in a company's equity or bond, you have to see, what are the operating margins, net profit, gross margin, and things like that. So these seem confusing. They're very, very basic things to look for. And I
Hmm.
do feel that as education increases, then people, will make that effort and learn a little more because it is, after all,
Yeah.
your own money. Yeah.
Yeah. And especially because I think a lot of these bonds actually are from NBFCs, which run a highly leveraged business compared to, say, a manufacturing company or something, right? I think that is why it is all the more important to basically to look at these leverage and debt servicing, etc., isn't it?
No, absolutely. Again, India is no different. Internationally, most of the corporate bond issuance actually comes from the financial sector, whether they are banks
Oh,
or financial institutions or insurance companies, because typically large manufacturing companies do bank loans versus like collateral, like a plant, machinery, an
right.
asset. And there's more sophisticated valuation that goes in this. So
Hmm.
again, we should not be surprised that large
Hmm.
borrowers or issuers are from finance as such. Yes, what we should be careful about is rating. And maybe if you don't mind, I'll touch upon that. I think
Definitely.
when an issue goes into triple B, it is
Hmm.
very, very high risk as per credit metrics. It should
Okay.
actually be dealt with banks and institutions and sophisticated investors. So even for
Hmm.
us, like we have 100 bonds on offer, we have maximum one or two bonds which may be triple B plus,
Triple B.
but
Hmm.
large deals in India which have been done. So triple B risk is usually from 12 to 18%. And I think retail may not be sophisticated to
Hmm.
understand that risk. So I think just as a benchmark, if it is under 12% or not close to 15% or 17, retail should
Hmm.
stay away from these kind of structures.
What do you mean by saying the risk is 12 to 18%? Could you explain?
Typically, the interest rate on these securities in
Ah,
the institutional market can
ah,
range
okay.
between 12 to
Oh, up to
18% coupon.
18%. Okay, okay,
Yes. I mean, there
mm,
was this large institutional deal 3 months ago, I think $1 billion plus, which institutions bought. A triple B minus, I can't name the issuer, but it went at 18.75%.
Oh,
Yes. So
okay.
my humble kind of suggestion or request to retail investors is that if you see
Yeah,
a triple B flat or a triple B minus rated
yeah,
issuer, please ask for higher returns because
right.
they should really start from 12 and can go up to 18%. Yes.
Okay, okay. And I think the other thing investors need to realize is that the credit rating they see at the time of buying the bond, that is not a permanent fixture. It could change over the holding period, right?
Absolutely. Credit ratings, again, they're a regulated entity. But
Mm,
thanks to if you're investing in bonds that are listed, then the companies are supposed to update on a quarterly basis. The good thing now is that
mm,
even debenture trustees are people who take care of the covenants or the rules and regulations under which the bond has been issued. They actually
yes,
now communicate to the holders if ratings have changed. So I think
right.
there has been amazing development in the country in the last year or two to
Yeah.
spread information, knowledge, awareness. Earlier, investor would never know if ratings have changed, but debenture trustees nowadays also communicate. A company is also supposed to communicate that. Yes.
So the debenture trustee is supposed to email the holders of bonds. I thought you're just supposed to go to the stock exchange and check it.
So in some cases we've seen then trustees actually, if they have the
Ah,
holders list, they communicate directly to
okay,
them. But absolutely, they have to also report to the exchanges, which then becomes public
right,
information. Yes.
right. So today we are seeing some online bond platforms actually offering securitized products, which basically means that they bundle many lower rated bonds into a package and they say this is a basket of bonds that you can buy. But and typically the retail understanding is that many securities are safer than one security. So does that really apply in case of such baskets of products?
So I think baskets can be formed in different ways. My personal opinion is that we are in such nascent stage of retail investor understanding bonds that
Hmm.
selling securitized products or baskets, are maybe early in the learning cycle is my
Hmm.
opinion, right? So
Okay.
on the face of it, you might think that you're getting a diverse basket of securities, but it also depends, are they all in the same sector? So what do I mean by that? This is called cumulative default probability. What does that
Hmm.
mean? So if I have 10 bonds and 6 of them are NBFCs or 4 of
Hmm.
them are, let's say, in any kind of, let's say, textile industry. So
Hmm.
if there was to be an external shock to that
Right.
industry, then I'll see a massive cumulative default happening. So even though I have 6 diverse
Huh.
finance companies or 4 diverse companies, the cumulative default probability is actually higher. So you will see that individually they might be rated higher, but because they are structured through a trust, their
Hmm.
cumulative rating could be lower than all of that. So
Yeah.
uh, I honestly, Aarti, I think these are little complicated products
Mm,
and may or may not be right for retail.
yeah,
Uh, and the right amount of disclosure learning is important in this case.
right. We also see some bank bonds being available on online bond platforms. Typically, these are, I think, perpetual bonds or tier two bonds. So, how should investors evaluate these bonds? Because when we see SBI offering 8% or some other bank offering close to 8.5, I mean, it looks quite tempting.
Yes. Again, in the past, in India, I think people, the awareness or how these bonds were understood were probably a little incorrect. And in fact, we
Mm,
have had history of 81s,
yes.
the investors getting practically zero.
Yeah.
But in terms of subordinated bonds, there are two kinds. One, as you said, they're tier two. Now,
Mm,
in simple language, tier two are dated subordinated bonds, which means they have a final maturity, usually, right?
mm,
So
mm,
they are considered to be little safer.
mm,
Uh, but the way you should look at it is that because they are riskier than a secured simple debt, you have to
yes.
ask for a higher return for it. That
Yes.
as
Yes.
simple as that. When
Mm,
we come to 81, it becomes a little funny and challenging because 81s come in a
mm,
lot of covenants, right? So they can have what does it simply mean? That if something wrong were to happen to the bank, any
Yes.
losses have to be absorbed by these bondholders. One
Yes.
example. Secondly, they are perpetual. And you
Yes.
have to know when is the call date, which means when the bank will call it back. Uh,
Yes.
a quick way to look at it is if the yield that you're buying at is much higher than the coupon. So let's say if the 81 is at 8% coupon,
Mm.
but you're buying at 10-12% yield, which means it is trading
Mm.
at a discount.
Right.
Now,
Why?
again, I'm trying to be simple. So basically, if
Yeah.
interest rates were to go much higher,
That's right.
economic
Ah.
decision may be taken by the bank not to call this bond. So you might be actually
Mm.
thinking you hold a 3-year bond, but you'll be holding a 30-year bond. So
Right.
these are inherent risks. Obviously, the issuer rating is important, but
Mm.
again, investors should ask for a higher return to take these risks. So
Right.
look at the issuer rating, see if it is dated or perpetual. And if it
Mm.
is perpetual, just see how much discount are you buying at.
Mm. Right. That's a good metric. Yes. So, what kind of investors are high yield bonds suitable for? Especially because in some of the privately placed issues, etc., we see ticket sizes going from 1 lakh to 10 lakh rupees. So, um, I mean, what kind of investors should go for this? And should senior citizens, etc., be using these bonds for regular income?
Okay. So I think most bonds, listed bonds in India can be bought for 1 lakh now.
Mm. Okay.
The word high yield comes from, that it's going to give you high returns. We
Mm.
understand that high returns means higher risk. So I think these bonds are suited for investors who are okay to take that risk. Usually bonds should be used to diversify your portfolio.
Mm.
Typically, an investor portfolio may have equities, real estate, gold in India, but people should not stay from bonds because bonds provide you a buffer. It gives you a regular,
Mm.
stable income. Now it is up to the investor. So usually we see on our platform right from 25-year-olds to 50, 55-year-olds, depending on where are they in the economic cycle, what kind of financial well-being they come from, that they can take that
Mm.
higher risk. So I would encourage first-time investors in bonds to start with a higher rated, like AAA, and earn 8.25% to understand it.
Mm.
Once they are
Mm.
comfortable, then they can start moving into the higher spectrum and
Right.
higher yield bonds, right? So, again, bonds should be a certain portion of your portfolio, uh, 30 to 40%, depending on your risk appetite. If it is 30%, high yield should be not more than 25% of that, right? So it kind
Okay.
of gives you that portfolio diversity. As
Mm.
far as senior citizens is concerned, it is a natural wisdom that the risk-taking ability of senior citizen is lesser. So we do not encourage senior citizens to buy high yield bonds for sure because they carry higher risk. Uh, but there are a lot of bonds, I think senior citizens prefer regular income, monthly coupon or
Yeah.
quarterly coupon. I mean, even on our platform, we have at least 15 to 20 bond choices. You can actually
Mm.
filter on our platform, say, I want monthly income bond issues, and it'll show you a
Mm.
list. And I
Mm.
encourage senior citizens to buy bonds for regular income, but stay on the higher rating spectrum for the same.
Right. Right. Absolutely. A final question. I mean, do platforms like India Bonds actually curate the bonds that they present to investors, or is it just a function of availability? I mean, do you apply some filters on the issuers, etc., before you present them on the platform?
So I would actually take this opportunity to tell you that between the two co-founders, we have about 40 to 50 years of cumulative experience of
Wow.
bonds and
Yeah.
underwriting credit, both in India and
Right.
internationally. We do
Right.
try and use that to filter. As I said, we do not typically show any triple B rated bonds. And if we
Mm.
do, maybe 1 or 2 out of 100 bond offerings. So we
Mm.
kind of do a little bit of diligence on our own. It is not
Right.
advice. It is just from our own experience, we think that
Mm.
what may or may not be suitable for a retail investor. So
Right.
we're not an advisory function, a pure platform. So just for
Understand.
this conversation to tell you that we do look at that because we both have a significant amount of experience in this. Uh,
Okay.
so that is how but the curation is,
Mm.
people have different requirements. Some people say that, hey, I want bank bonds, or I want only public sector bonds, or I want
Mm.
only high yield bonds, or I
Right.
want bonds from like a 2-year to 3-year maturity. I think we are one of the largest offerings amongst bond platforms in the country.
Okay.
So we use these filters where investor can curate as per their needs. So an
Right.
investor might think, I have money for 2 years, show me only 2-year maturity bonds. So there's a customer filter where he'll does not have to go through our entire offering, but he'll only be shown that curation.
Right.
So it's more a filter for selection, but given a wide choice for our investor.
Yeah. Okay. That makes sense. So thanks a lot, Mr. Goenka. With that, we will close our conversation on bonds. And it was a very insightful session. And I'm sure retail investors would have taken away quite a lot from this. Thank
Absolutely.
you
It was
so
a
much.
pleasure talking to you. Thank you so much for the opportunity.
Thank you.